Hello, and welcome to How to Keep More of What You Make, Managing Your Tax Bracket. This webinar is brought to you by a partnership between STFM and Equitable Advisors. Our panelists today will be Stephen Dunbar of Equitable Advisors and Dr. Lauren Gibson-Oliver and Dr. Wayne Bryant Jr. of the University of Arkansas for Medical Sciences. Resources supporting our presentations content will be available at stfm.org/financial wellness. During this webinar, please utilize the Q&A feature to ask questions of our panelists. You are invited to ask questions at any point during the webinar. And now, Dr. Bryant will begin our introductions.
Well, hi everyone. My name is Wayne Bryant Jr. I come from Florida. I was born in Tampa, Florida, and I'm here in the state of Arkansas. I did my residency here as a chief resident, and then also for me, I've been here. I've been an associate program director. So one thing that I love here in education is just I love working with residents. I love working with medical students. I am big on advocacy and also about helping with health disparities. And so I've actually been, I think the most thing I'm most proud about is that I'm a girl dad. So I have two
Mm.
beautiful young girls, like 2 and 5 year old. I have a 2 and a 5 year old, and I'll pass it off to Lauren.
All right. Hi, everybody. I'm Lauren Gibson-Oliver. I am also at the University of Arkansas for Medical Sciences. I am the program director for the Family Medicine Residency Program. I'm going into my fourth year as program director now. So I've been here after residency. I did my residency here. I was also chief resident and have been here ever since. I also love residents and working with them. My kind of main focus is professionalism. That's one of my favorite things to work on with residents and to just see how it changes over the years. I am also a girl mom. So I have a 3-year-old and a 6-year-old, and they are just wonderful and energetic, and it's definitely also the best part of my life. And I'll hand it off to Stephen.
Thank you, Lauren. My name is Stephen Dunbar. I'm a collaborator of STFM's. I believe in what the organization does so much so that I personally donated to the foundation. I view my role as really being a resource to anyone who wants to work to get to what we're going to talk about today on some level, which is financial freedom. I want to start teeing that concept up with you, Lauren. Please give us kind of the best financial decision you made. What would that be?
Sure. Thanks, Stephen. So I think overall, the best financial decision that I've made over the last my life, I guess, would be purchasing a home.
Mhm.
So I purchased my home at the end of my residency, kind of in the middle of my third year of residency. Once I knew that I was going to stay and stick in academics and stay in Arkansas. At the time, the interest rates were really, really low,
Mhm.
and so for me, that was a big driver for myself and my husband to purchase the home. I was also pregnant with my first child, and
Mhm.
so that was another reason for us to do that. We had lived in cities during medical school and everything where the cost of living was much, much higher than it is here in Arkansas. And so we were used to paying rent, and that was just kind of, I guess, what we thought we would do forever. But we were in the situation to be able to purchase a home here in Arkansas where the cost of living is not as much. We also bought a home that was a little bit larger than we needed at the time, just in anticipation of what was to come, including having my mother-in-law come and live with us and help us with the children. And so that was really my best financial decision that I've made.
Fantastic. It's interesting because uh, we can either make really good ones that have permanence, or we can make really bad ones that have permanence. You made a really good one that has permanence because of the low interest rate and getting more space, so you had room to grow. A couple of things I want to pass off to the audience to think about as we manage our tax bracket. There's a few ways to deal with that. One is you're going to deal with it with write-offs, right? So when you think about if you are doing something outside of your W-2, you're doing some locum tenens or you're doing some of work outside of your W-2 and you're getting paid as an independent contractor, pay attention to your expenses because you can write that off to reduce that income and therefore reduce the taxable burden that will be assessed on that income. From a mortgage expense, Lauren talked about buying a home. So there's a portion of that mortgage expense that you actually can write off against your income if you itemize. So pay attention to that. You'll get that from the mortgage company, whoever your lender is will send you that statement at the end of the year. Pay attention to that. That will help you a little bit as well. The other thing I like to point out is charitable giving. If we are already charitably inclined, we can charitably give, and that actually can act as a write-off. Just to give you a little bit of that, some detail, you should definitely work with a CPA. I'm not giving you tax advice here, but just to give you a little bit of a flavor for it, because of the big, beautiful bill, there's going to be a floor that you will not get credit for. So it's basically 0.5%. So if you take whatever your income is, you multiply that by 0.5%, that number will be, you won't get credit for that number, but everything above that. And so what are you allowed to give? You're allowed to give up to 60% of your adjusted gross income. What is your adjusted gross income? That's the number that shows up on your tax return after appropriate write-offs, like contribution to 401k. So you can actually see that on your tax return, adjusted gross income. You're allowed to give up to 60% of that. If it is cash going to a public charity, STFM, by the way, qualifies. They want to make sure I say that. So I've said it. 60% cash, 30% securities. Now, are any of us going to give 60%? No. But if you give let's say a $5,000 or $6,000 donation, that will be an additional write-off against your income. The other big place to look for savings from a tax standpoint is deferral of your income. So if you are W-2 working at a hospital, like Wayne and Lauren, putting money into your 401k, it reduces your income. Just so the math is easy on all of us, if I make 200 and I put 25 in my 401k, I only pay tax on the 175 left after my 401k contribution. So please, if you can defer that money, you don't need it to live, take advantage of that because that's going to bring your tax bill down. The other big thing is HSA. Take advantage of the HSA. A lot of people have it and they don't take advantage of it. That also will bring your tax bill down. So you're allowed to put up to 7,000 away. If you put 7,000 in, you don't pay tax on that number. Last thing in terms of write-offs and deductions, if you are doing something outside of a W-2 on a 1099 basis, remember you can defer that income as well. So you could put together a SEP or a simplified employer retirement plan. You could use an IRA, you could use other vehicles, but you're allowed to defer that income as well. So if you have outside money you're making, pay attention to the expenses to reduce the tax bill, but then also think about doing a deferral program, much like a retirement plan. Here's my last concept I'll say, and this is probably the biggest thing I like to work with on people who are working in large companies, hospitals, and so forth. When you look at the value of our compensation, and the Department of Labor has done statistics on this, if you look at the value of our compensation, only 70% of it is the actual cash you're depositing in your bank account every 2 weeks. The other 30% are all the goodies that are in the benefits package you get on day one. And many of us put it in the drawer or file it in the computer and never look at it again. Pull that out and dig into it because a lot of goodies are in there you want to take advantage of. I can certainly work with anybody one-on-one to do that analysis if you want me to. But that's a little bit about bringing their tax bill down using write-offs and deferrals. Lauren, is there anything you want to add, having said that, kind of from your experience about that issue?
Yeah, I think that was something that I had to really dig into and research a lot when I joined faculty, and from being a resident. I think as resident going through medical school and everything, we have kind of all this, kind of waiting to get to that next point. And so, I think it was a matter of really trying to be smart about things, and not just spending my whole paycheck. And really looking into all of the benefits that my employer offered, like 403B matching and things that can really help me in the end. Because what you said at the end with the benefits package, I think that was really a big surprise to me, is how much was offered, with the hospital system, from a benefits point of view, because that wasn't something I had ever experienced, not really having a real job, I guess you could say. His real job is kind of a understatement, but
Yeah.
not having like a professional job after my education.
That's really good. Actually, let me dig in a little bit more because you just brought up something I want to point out to people. So, first of all, remember the child tax credit. In
Yes.
2025, it was $2,200. What does that mean? That means if my tax bill is $20,000, I get to reduce that tax bill by 2,200 and pay the difference. It's a dollar for dollar offset to your tax bill. So even though the dollar amount is not huge, it's still a dollar for dollar offset. How you get that? It is per child with no maximum. So you have the one child, you have 5 kids, it's per child, no maximum. The last thing to think about is, and I'm saying this because I'm hoping some of you are there, I'm speaking very positive things for you. It begins to phase out at 400,000 of household income. By 600,000 of household income, you don't get the credit anymore. Again, I I hate if you lose the credit, but I want you to make 600,000. So hopefully some of you are phased out. To Lauren's point about benefits, just to give you an idea, I have clients when you look at the benefit of the contribution and match, because you'll have a match, meaning if you put in 3%, your employer puts in 3%. That's a match. Some employers will actually make a contribution above your match as well, based on performance of the organization. Some employers will provide ownership in the organization. You all probably are not going to get that because you're nonprofits, but the match is definitely there. Here's what my point, just to put it in dollars. I have clients that get as little as 3,000 a year from this. I have clients that get as much as 30,000 a year from this. This adds up over time. The other thing not to sort of let slip by you is for each of us, we're going to spend somewhere between $250,000 and $500,000 on sort of standard medical expenses, not long-term care and high-end assisted living, but just standard medical stuff. Take advantage of that medical plan at the office because that is going to bring that number down. Your typical employer for a family is kicking in typically $27,000 a year to help you with medical costs. Dig into what's there and take full advantage of it. Because every dollar saved is the dollar earned towards your wealth creation. Wayne, if you would please tell us, what is your best financial decision, would you say?
Well, I was gonna jump off of Lauren's when she said her best investment. At first, I thought she was talking about her mother-in-law. I was like, "That's the best
Oh, that
investment
that
of
is
my
a good investment too.
with those kids." But I was thinking too. You just taught me so much in like a couple of minutes.
Mm.
I was just thinking about how I've already got the 10% match here for our 401k for our job, and I think about my contributions. I do like ties. I do like 10% every month with my check, so I can
Mm.
basically gets written off. And then also I do a consultant job too. I do one, so I actually do the tax break stuff for the Microsoft Word. I get the electricity, the
Yep.
transportation, the electricity, and so I was thinking about those things, how that's been really helpful.
Awesome. Awesome.
I would say I would say for me, and it might sound a little cheesy, but my greatest investment is my wife.
Mm.
I think that's been really good. You have to kind of know. Someone told me that the best investment you ever make is the partner you choose, and being able to understand about that delayed gratification and when we can actually be able to get the things we want, but we just may have to wait a little bit. But I think having that partner, being able to be understanding, and during this process while we're growing and going through academics, and as I'm moving forward, how we're able to create that wealth and understand the delayed gratification so we can enjoy later on as far as savings wise when we want to retire.
That is such a good point, Wayne. I'm going to give a visual, and then I want to ask you at the end of the visual if you wouldn't mind maybe sharing one example of what delayed gratification looked like for you and your wife. Okay, so here's the visual I like to give people. I work with a number of households, and people are always fascinated about what's the silver bullet, what is the secret sauce to creating significant wealth. And I love telling this story. I'll tell them a story about a husband and wife who own a beach house. I'm not going to say where because I want to protect their privacy, but it's a place where anybody would want a beach house, and it's a fabulous house. They have put multiple grandkids through college. They give very generously, and their net worth is, most people would be pleased to have their net worth. So I explain all of that, and I say, guess what you think they did for a living? And I get investment banker, private equity, doctor, lawyer. I mean, I get all these really fancy professions. And then I say, no, one was a teacher and the other was a superintendent, a principal, excuse me, a principal. Why do I share that? It basically, they live by the principle Wayne just said. From the beginning, they knew the way they were trying to go. and they exercise a little bit of delayed gratification so they could get a fast start on building their nest egg. And I tell you what, that created incredible leverage for them. So that's the visual I like to give people. You all are fortunate you're going to make a ton more money than they ever did in your careers. But Wayne, for you, what's an example of that when you say delayed gratification?
Yeah, before I got into residency, we were just pretty much living on my wife's paycheck,
Mm,
and probably like in Baltimore, $30,000. But we also wanted to make sure that we kept our marriage fresh. So sometimes we wanted to go on vacation, or we would go somewhere away for a month. And so we would actually save a little bit of money here and there so we can actually enjoy at least one big vacation a year. And then every 3 months we would basically go on somewhere. It'd be somewhere close that was like a drive away, stay in a
mm,
hotel for a little bit. So sometimes we wouldn't go out to a restaurant, every day, or we would pack our lunch. It just kind of happened in that way, just so that we can enjoy that trip that we can go on for like 7 days, because we would just kind
mm.
of put away a little bit of money at a time for her. And because at the time when I met her, she had a really bad credit score. I know she won't kill me for saying that, but it was really bad. And I was really concerned. I was like, oh, we got to get this up, because we ever get a house one day, I got to get your credit score up. And so being able to like invest those principles and talk about budgeting, and even though we have a little bit more, we still do the budgeting because there are things that we want to do and invest in. That's why we invest in the 401k and our Roth IRAs, and it really has been helpful for us so we can look at it in the future. So she's actually better now. She's like, oh, we have it for the budget. We're gonna put this in the budget. I want to do this, and so she
Yeah,
she understands the principles, and so now her credit score is, it might be better than mine now, but she's done a great
I
job
love it.
fixing
I
that.
love it. I love it. One example, that's a great example. Another one I'll share with you all is if you are not currently maxing out your contribution to your retirement account at the office, then pick a percentage. Let's say you use 10. And so I'll do that. So, 10%. And if that's not maxing you out, then set your contribution to automatically increase by 1% a year. So you started your real job. Lauren, I guess I shouldn't call it a
Sorry.
real job. I see. I,
Real
I
job.
almost said it. I stopped myself. You started your well-paying job, and you go in and set your benefits up. When you do that, we will do some percentage, and then we don't look at it for 5, 6, 7 years. When you do that, put the percentage in and tell it to increase 1% per year until you get to the maximum. You will never see it happening. It'll slowly increase, and you'll never feel it. That's a form of delayed gratification, sort of a principle behind it. Wayne talked about Roth IRAs, so I just wanted to give you some numbers there. This is the thing I see people getting caught by, and I've seen it a lot. So I see people putting money into Roths, and they're not allowed to because they've exceeded the income threshold, and there's some pretty significant penalties when you do that. So from a Roth standpoint, your income threshold is married filing joint. 242 is where it begins to phase out, and by 252, you're not allowed to use a Roth anymore. So if your household income, married filing joint, is over 252, please be careful about putting money into a Roth IRA unless you're doing it via a Roth conversion, right? And I can talk about that at some point if somebody wants me to. The other thing I want people to know is the HSA contribution for a family is 8,750 for 2026. And if it's just self, then it's 4,400. A couple of principles given what Wayne just shared with us. Since you all are physicians, I like to use the concept of cholesterol. We all know high cholesterol is not a good thing. So from that standpoint, what I want you to think about is we have this concept of tax cholesterol that we think about. And when I'm talking about tax cholesterol, think about 3 periods. All of us, me, Wayne, Lauren, all of you listening, there are 3 periods we go through from a financial standpoint. There's accumulation, which we are all still actively in. Those are our earning years where we are building our nest egg up. The second phase is spend down. That's when you start drawing on everything you've saved to cover your expenses. Hopefully you've gotten to that financial freedom point. And then the third phase is transfer. So both Wayne and Lauren talked about 2 kids. At some point, whatever they have left, they're going to transfer to the next generation. There's tax implications in all 3 periods. During accumulation, we've talked about that today, which is using write-offs, using deferrals, funding your HSA. We're trying to reduce our effective tax rate during our earning years. Once you get to spend down, you want to think about the concept of asset location. You all Most of us know about asset allocation, which is I have $10,000. Asset allocation is the idea of not putting all 10,000 in a single stock or one mutual fund. It's the wisdom of don't put all your eggs in one basket. So instead of doing that, you spread your 10,000 out across various stocks or various mutual funds so that you are diversified. Why do you want to be diversified? Because in any one year, if you're spread out, you will have some high performers that might offset the losses of a low performer. And over time, by having that diversification, you will do better in your investment strategy. And everybody knows about that. But asset location, not many people know about. So to drive this point home, in the pre-call, we learned that one of our colleagues was a high school teacher. So to drive that point home, I'm going to go back to channeling our elementary school days, all of us. Everyone, I'm sure, on this call played hide and go seek. The goal of hide and go seek was not to be found. Here's my news flash for everybody on the call today, okay? We are still playing hide and go seek. We're just now playing with the federal and state government in terms of income taxation. So the goal is you find a decent hiding spot. That's the idea of asset location. There's only three of them. One is as long as you don't touch the money, they can't see you and therefore they cannot tax you. Second is they can see it every time. And so every year they're going to ask you for you to make tax payments on it. The third, they can never see it and they can never tax you. What are those three hiding spots? Taxable, tax-deferred, tax-exempt. Taxable is your standard investment account. Think Robinhood, think Schwab, think Merrill Lynch. Equitable can set up regular investment accounts. Those investment accounts, at the end of the year, you will get a 1099. Whoever the vendor is will send you a statement saying, for the year, here's your gain. You have to report to the IRS. And then you have to pay taxes that get added into your adjusted gross income. You pay tax on it. The advantage of that hiding spot is the money is liquid, meaning if you need it, you get it right away. The disadvantage is you pay taxes on it every year. Second hiding spot, tax deferred. That's your 401k, your 403b, all these retirement accounts. The money goes in with no tax. It grows with no tax. But the minute you start spending it, which you're eligible to begin taking it without penalty at age 60, that's when you begin paying tax on it to $1. Your final hiding spot is your tax exempt. The one most of us know is a Roth IRA, but there's several other ways to get that same treatment. The money goes in once you've paid tax on it, but once it's in there, you never pay tax on it again. Here's the visual I would leave you all with, and there's an asset location website that I'm going to share with you all, and you go kind of look at it. It'll give you a little additional education on this. Your best case scenario is to have your nest egg at your financial freedom date be a third taxable, a third tax deferred, a third tax exempt, because that will allow you to literally control the amount of income tax you pay. I'll give you a very simple visual on that, and then we're going to move to the next concept. If all of your money was in a tax-deferred account, meaning all of your money was in a 401k or 403b, and you need $100,000 to live, this is a trick question, and if you all were physically with me, I would drag this out a little bit, but for the sake of the format, I'll get right to it. You would have to withdraw roughly 125 to 130 to net 100 into your bank account, because again, it is now taxable since you're taking it out. So you need to take enough out to pay your federal income tax, and depending on what state you retire in, your state income tax, and the net of 100 to go in your bank account. So because people don't plan appropriately, that extra 25 they're taking out drains the nest egg faster than they thought. By comparison, if all of your money, and this is not possible, I'm doing this for visual, if all of your money were in a Roth IRA and you needed 100, you would take out 100 and net 100 because you don't pay any tax. So you want to fund all three of those buckets, because your tax deferred will have an effective tax rate, depending on how much you take out, of anywhere from 7 to 12%. Your taxable will have capital gains tax rates, which could be anywhere from 0 to 20%. And then your tax-free bucket will be 0. And if you take out the proportional from each of those, I've shown people ways to go from planning to pay 28% in retirement income tax to 6%. Obviously, it lasts longer because you keep more of what you make, which is the whole point of today's conversation.
Can I ask a question about
Yes,
that?
you may, please.
So
Go ahead.
I know, Wayne, you probably have the same question. So if you say one third, one third, one third,
Yes.
but we have limits
Yeah.
on how much we can contribute, how do we get to that one
Yes.
third, one third, one third?
Great question. So I will answer it in concept, and then I'll give some specifics. In concept, you want to have a written financial plan. The reason you have a written financial plan is because you want to go forward to your financial freedom date. By the way, I'm saying financial freedom because this idea of retirement is not a thing anymore, right? No one sits in a rocking chair and does that. Financial freedom is I get my time back, now I can go do whatever I want to do. So if my financial freedom date is, say, age 57, Lauren, what I'll do is say, all right, I need this amount of money at age 57 to have financial freedom. Then I work backwards by taking that amount of money, making sure I have it in the appropriate buckets, and then I work backwards to funding the buckets. How do I do that? The taxable has no limitation, right? You can put as much as you want, anytime you want, into a taxable bucket. So that's not the one we have to worry about. The ones we have to worry about are the tax deferred, which is a $25,000 limit until you're eligible for the catch up. And then you can put an extra, let me slow down because I take this for granted. Let me slow down. In 2026, if I'm below age 50, I can put away 24,500. If I'm between 50 and 60, I can add $8,000 to that number. So that's 32 and a half. If I'm between age 60 and 63, I can add another 11,250 to that number. So I'm putting away 24, 34, 30, 44, 45. Somebody can check me on the math. So Lauren, what I would do is I would look at my ability to fund the tax deferred bucket over time and make sure I'm maximizing that opportunity. The most challenging bucket is the tax exempt because a Roth IRA on a converted basis, you can only do about 7,000 a year. So how in the heck am I going to get more money into that? There's a couple of options. Number one, do a mega backdoor Roth. Make a contribution on a non-deductible basis to your company retirement plan and then sweep it into your Roth IRA. My company allows a pretty significant number. You got to just check your benefits. Do they allow you to do 8,000, 10,000, 15,000, whatever it is? Make that contribution non-deductible, sweep it into your Roth. The other thing you can do is some companies have a Roth 401k, right? Wayne, I see you shaking your head. I can't see you, Lauren, because my screen is on Wayne. But a lot of people don't realize there's not just the traditional side on a 401k. There's also a Roth side. So your company may have a Roth, which means those numbers I talked about, 24 and a half, 32 and a half, and so forth, you can do all Roth if you want to. So that's a question of timing with your CPA of like, how much do I use on the Roth side versus the regular side? And when do I do that? And you want to think about your current earned income because you're trying to minimize your tax cholesterol, right, in accumulation. But that's another way to do it. And then the last way to do it that I find people know the least about is actually cash value life insurance, where you're buying insurance not for a death benefit to be paid to a survivor, but you're buying it to treat it as a tax shelter for your nest egg to be distributed when you get to financial freedom.
That's really good. Yeah, I forgot to bring that up too about how I have a financial advisor, which has been really, because I didn't know what to do with my 401k to diversify my account. He looked at it, he's all right, go here, here, here. He just, because
Yeah.
I'm more like a more
Yeah.
moderate risk, I say, and
Yeah.
he's high risk. He's like, yeah, you'll be fine, just put it here. And he's been really helpful to be able to have it. And then also getting a person that does my taxes. That's been wonderful. What I would have taken days to do on TurboTax, took them like a day. So,
Yeah.
and it was
Yeah.
like $300, so it was really worth it. But I just wanted to say that because we had a couple of questions actually on the
Oh,
same topic we've been talking about, and I
you
wanted
want
to,
to? Yeah, share them. Let's make sure we cover them, please.
yeah. The first one was about more. So they said I'm trying to figure out what tax bracket I'm in. I know my
Mm,
annual salary, but based on what you were saying, I need to subtract the 401k, etc., to know what is my actual taxable income. So I
right.
see where in the bracket I land. I think you mentioned something on the W-2, but I
Yeah.
didn't catch where.
Beautiful. Thank you for asking that. So, all right, a couple of things. One is you're going to get a resource, and it's called 2026 Tax Facts at a Glance. When you go to that, you will see for 2026, it will show you if you're married filing joint or if you're filing single, it will show you your tax rates depending on your income. Here's the thing I want to share with people. Most people don't realize there's not a single tax rate. It's not like, I talked to Wayne, and Wayne said, and this is not his income, okay? I'm using this for example, everybody. Wayne says, I make $335,000 a year. Okay, I go to the tax table and I say, what's the tax rate for $335,000 a year? That's not how it works. The way taxes work is you pay a rate given your band of income. So from 0 to 25,000, you pay 10%. From 25,000 to 100,000, I'm rounding these numbers off for ease. From 25,000 to 100, you pay 12%. From 100 to 215, you pay 22%. From 211 to 403, you pay 24%. So Wayne's fictitious 335,000, his highest marginal rate is 24 because his last dollars are in that range, but his effective rate is going to be much lower than that because, as I told you, he's going to pay 10, 12, 22, and 24. So if I blend those, his effective is going to be somewhere in the 19 to 20% range. So you want to think about your effective tax rate. The next thing you want to do is say, if I can afford to live without the money, I don't need to pay light bills and pay gas and buy groceries. Think about your deferral in your 401k as keeping you out of the next maybe tax brackets. Because let's say you make 220. Well, if you max out your 401k at 24,000, you've taken yourself out of the 24% bracket and dropped yourself down into the 22 as your highest marginal. So you'll see this and play with the math. Please feel free to reach out to me if you want. Anybody needs help with that. In terms of your W-2, the reason why that's a little squirrely is because your W-2 is going to show all your income. It doesn't really have your effective tax rate. It just shows what is being withheld from you based on the withholdings you put on your I-9 form. So if you put 7 compared to somebody who put 2, the person who put 7 will have less tax withheld, but that's not your effective tax rate. You want to look at this math and work with your CPA to look at where your rate will be on a projected basis. The W-2 is just going to show you what's being withheld towards your tax bill when it is due. Any other questions, Wayne or Lauren, that we should dig into from the chat at the moment?
Yeah, there was one about Roths that I'll read it. This attendee said, you mentioned the Roth conversion, but I get confused with the rollover versus conversion, etc.
Yeah,
I
good
put
question.
after-tax money into a traditional IRA, and then a few days later, I moved that from the traditional to the Roth. Does that sound like the correct setup for getting a Roth if you are above the income threshold?
That's exactly the right setup. They nailed it. And just to go back to the beginning question, rollover versus conversion, a rollover would be when you take an existing account and move the custodian from one to another. And a rollover can be either tax-free or it can have tax consequences. So the classic situation is, Lauren's on my screen now. Let's make up a scenario. She's working at her 3rd job since finishing. I'm sorry, I know it's all fixed. It's fictitious. She's working at her 3rd job, which means she's had 2 others, and she's got some retirement money at those other 2 jobs. People are always like, what do I do with that? Do I leave it there? Do I do it? Okay, so what do you do with that money? You roll it over from your old 2 employers, either into your current employer's plan or into an IRA that gets managed for you. That's a rollover. Just very quickly there, how do you decide? Depends on your appetite. If you're a do-it-yourselfer and you love investing, the cheapest thing to do is to roll it from your old plans to your new plans, because your retirement plans at the office generally are going to be in the 15 to 20 basis points, meaning 0.15% to like 0.2%. So they are very inexpensive. The challenge with those plans is they don't have many options. There's usually about 12, 13. The most I've seen is 20 options. An IRA could also be cheap because you could go to like, it's not E-Trade. There's another vendor, but I'm not advocating for any vendors here. There are vendors for whom you'll have no costs, right? And you do all your own trading. That's the cheapest. I'm going to give a principle now based on what Wayne said. One of the things that I try to really share with people is you have 2 kinds of people. You have people who will spend their time to save money, and you have other kinds of people who will spend money to save their time. Please, please be the latter. Spend your money to save time, because time is the only resource we can never replicate, we cannot reproduce, we cannot get more of. Your time is your most valuable thing. So I'm off my soapbox now. That's a rollover. The Roth conversion he was talking about, that's how you do it. You do a non-deductible contribution to a traditional IRA. And the reason it's non-deductible is because you're not trying to get the tax benefit for it. And then you immediately roll it into your Roth. That's the simplest way to do it. The only limit there, Lauren, as we were talking about, is it's $7,000 a year. With the catch up, it goes to $8,000. So it's very hard to robustly fund that tax exempt bucket. That's why people with the ability to will move to other things, the mega backdoor Roth, Roth 401k, cash value life insurance.
Yeah, I think that concept you said about spending money to save time, I think that was something, especially very early in my career, that was very challenging to think about that. But it's definitely a mindset change that I had to make, and it's always a conversation that myself and my husband have about, okay, well, how much time would that take us?
Yeah.
And what is our time worth to us? And
Yeah.
as we get further in our careers, as our children get older, I think it's definitely our time is worth more to us.
100%. So because now you put me, this is my soapbox, because if I could help people figure out how to get their time back, I think our quality of life skyrockets, because then we are controlling the time in terms of with whom we spend it and how we spend it. So let's say we're making, Lauren, you're on my screen again. I'm going to give you a fictitious income of $375,000. Okay. So do me a favor, please. Let's all get our calculators out. This is a fun game, I promise. Let's do 375,000.
All right.
307. Everybody, even our listeners, please do this with me. 375,000 divided by 1,920. What do you get?
$195.
Yes.
Per hour, is that?
You got it.
Okay.
So 1,920 is basically a full-time equivalent. Now, I know as physicians, you're working probably harder than that, okay? Because that's like a 40-hour work week for about 50 weeks, right? So I understand you're working more than that. But if that's a full-time equivalent, your effective hourly rate is 195. So the principle is, if there's something you need and it costs less than $195, pay for it. Because then you maintain your bill rate and you maintain your quality of life. Don't do $10 an hour work when you're making $195 an hour. It'd be better for you to sleep and go back to work more refreshed. Because I have my friends who love their lawnmowers and their wrenches. By the way, I don't know how to use a hammer with instructions.
My husband loves mowing the lawn.
Yeah, see?
He won't give it up, but he loves doing it.
No, so that's a different kind of compensation. He's getting joy out of it. That's okay. That's okay. But if it's a joyless task, just pay for it. So any other questions in the chat before we move to another question from one of you?
Well, I have one quick question.
Yeah, sure.
More in the chat. So I remember I was telling you about the consulting job that I do. So I don't know, maybe I'm probably should stop doing it, but what I do, I have an ally bank. And so what I do is I put half of the money that I make from that, I just put it in that account. So that when I don't touch it, so when taxes come, I can kind of take it when whatever's owed. But it gains interest on it because it's an ally. I think it's like maybe 4%. How would that work would that work against me and I guess my taxes when they look at that and I have to report that?
Good question. All right, so a couple of things. Let me directly answer your question. Any interest earned, yes, would be included as taxable income when you're doing returns. But in reality, dollar amount of interest earned is probably not going to be significant enough to move the needle. And I love what you're doing because you're keeping the liquidity so you don't get a tax surprise, right? So I love the concept of what you're doing. I would approach the concept maybe this way. Work with your CPA and say, based on a projected level of earning in my outside gig, what is my reasonable amount of quarterly contributions I need to make? And then you can make those, you lose the interest write-off. I mean, you lose the gain of the interest, but you avoid the penalty. Because the problem is if you don't make quarterly contributions, then they give you the business and say you should have. And so now you're going to pay some extra taxes and all that. It is and the interest gain is not significant enough So you might as well do the quarterly payment as a way of getting to where you're getting. That way, you also have a real number, and you might free up more liquidity to put elsewhere in your plan. That's how I would approach that.
Okay, great.
Yeah.
And can
Thank
you
you.
talk a little bit of more? Sorry, Wayne, did you work? Were you?
No, no, you're good. Go ahead.
I was just wondering a little bit more about quarterly contributions instead
Mm,
of or quarterly payment, like tax
yeah.
payments instead of
Yeah.
annual payments. At what point do we need to start thinking about that, or when should we not do that?
Yeah, that is such a good question. So, because you are a W-2, Lauren, there's a withholding taking place in your payroll already at a
Right.
base level based on whatever you put on the withholding forms. The reason to think about doing more than that is there's sort of an emotional reason and there's a financial reason.
Okay.
The emotional reason is people just despise getting a large tax bill. Like it just drives them bonkers to have their tax return done and the accountant says, "Hey man, you owe another $50,000." So they say, rather than getting this big surprise, hey, let's break it down and let me do quarterly so that I either have a zero tax bill or maybe I get a refund. I would not advocate getting a refund because now you gave away your money for free. So whittle it down so you get either a zero or a more modest tax bill. That's the emotional and the financial reason. You're trying to avoid getting a huge bill that then you have to start moving things around financially to afford, unless you're the Waynes of the world who actually put their money in cash waiting for it. But he is not normal. Most people don't do that. That's why he's a panelist on this call. Did I answer your question?
Yes, and
Yes.
there's actually a question in the chat about
Yes.
that as well. So this attendee said, I have struggled to do the quarterly payments. I think I know how to figure out how much I need to pay from rental income, but I haven't been able to figure out how to actually make the payment. Do you know how specifically to do that?
IRS.gov. IRS.gov, and you'll create an ID for obvious reasons because you got to protect yourself. And once you have that, you go in and you'll go to your unique tax footprint, and then one of the drop down menus is quarterly payments, and then you make it for. They'll tell you which tax year you're making it for, and you make them there. Because I make quarterly payments because I don't enjoy getting a big bill.
I definitely get that.
Yeah,
Don't tell me I don't want to hear.
yeah, seriously. I am just looking. I think we covered most of that. All right, let's talk about tax loss harvesting. Unless there's other questions, I think I see one popped in. Laura, did one pop in? Because otherwise I'll
Yes.
talk
Yeah.
about that. Go ahead.
It's about claims for a child. So it said you mentioned
Mm,
claims for each child. I'm assuming only one spouse can make this claim. How do you decide who makes it and does it matter?
Good question. If you're married filing joint, it doesn't matter because you're getting the child tax credit per child against your combined tax bill. Yeah.
And if you're filing separate or if you're single, I
If
guess
you if you're
file separate.
single, then you would get it. If you're married filing separate, please, and I'm not kidding, if you're married filing separate, please call me after this call. That is the worst tax filing status. It is really bad. So
Good to know.
there's some emotional and relational reasons why there are some people who are in that position, but if there's any way not to be in that position, you do not want to be in that position.
Um, but you said married, five, single.
Separate.
Separate, separate,
Gotcha.
separate.
Well, I will say this. So my wife has like loans, and
Mm,
with her, she's able to get it, like, her loans basically deferred.
okay,
But she basically, in order to not do our income and include mine, she was able
okay.
to not include mine. So we were able to do that, and it helped
Mm,
reduce like her bill that she would have to pay monthly, or how much she would owe. She can basically just pay, I think it's $3,000 instead for her to
yeah,
finish off the rest of her loan payments, which is 20. And
yep,
so that was, I mean, I don't know if that's something that was if one benefit, I guess, if we had
yep.
school loans. But yeah, mostly we definitely don't do that because it never has saved us any money at all from the tax standpoint.
So we don't want to go into, thank you for sharing that. Um, you and I can have an offline conversation. But what
Sounds
I would
good.
say is, for example, married filing separate. You remember I was talking about the phase outs to use Roths?
Yeah.
Those phase outs drop to almost zero. So if people are married, filed separate, the first thing I do is I look at, are you obeying the reduced phase outs? Because that's where they get tripped up.
Yeah,
So that's sort of a generic thing. More specific, you and I get into it. Okay.
that sounds good.
Yeah.
Yeah. Wait,
There's a follow-up question to
Yes.
that
I was about to say I had
in the
one.
Q&A. So this said, but you could be in a couple and not married, so filing individually. I
Yes.
think the question before was maybe about this scenario and how to decide which of the two partners should claim the children.
So if I'm understanding it, we have a child in common. We are not formally married, and we're trying to decide which of the two should claim the children.
Yes.
Um, I'm uncomfortable answering that because it requires me to ask some follow-up questions.
Okay.
So I would encourage that person either ask your CPA, or if you want to really talk to me about it, I will put my email in the chat and just send me an email because it requires some follow-ups before I can give an answer to that. Yeah.
Okay.
Yeah.
Good
And
to
I was
know.
gonna say with when you have if you have the, say for instance, like I have the dependent care flexible spending account.
Mm-hmm.
I'm not able to do both, like to get tax break for my kids and that, correct? That's what I was
If
told. If I have the
for the
dependent care flexible spending account, and if I wanted to also do, I think someone mentioned about when I'm looking at our past questions, um, about claiming your child on your taxes. Basically, are
yeah,
you able to do both? You can't.
yeah, you can't. Well, so I want to again, I'm not giving tax advice. Y'all don't get me in trouble. Okay. Check with your CPA. But what I would say is this: the child tax credit is a different thing than claiming your child as a dependent. The
Gotcha.
ability to be able to claim your child as a dependent is something that we have not been able to do for some time. They got rid of that. The replacement from it from the big beautiful bill was this tax credit you can claim as a child. And just so I try to explain the difference in my mind, if I am if I have income of 200 and I used to be able to claim my child as a dependent and would, let's say it was a $5,000 number, my $200,000 income drops to 195 for purposes of income taxation. That's the way a deduction works. A tax credit, which is what we have today, is, remember, I have a tax bill of 50,000 and I get to reduce it by the $2,200. So that's the way a tax credit works versus the deduction. The idea of deducting children and dependents, I don't think we can do that anymore. Now we have the tax credit is what's available to us.
So you can get that tax credit, but can you do, like I have the daycare one that I do, so I am I able to do both?
I believe so. Yes, I believe so. But confirm with your CPA because now you're getting into real technical tax advice.
Okay.
Don't make me practice medicine either, Wayne. Okay.
All right. Fair enough. Fair enough.
uh, any other questions in the chat? And then otherwise, I'll go to tax loss harvesting rule because that's another one I get a lot of questions on.
Yeah, not at this time.
Okay, so with tax loss harvesting, what is it and why would someone do it? What it is, if I own a stock in my investment account, and this is the only place where I'm going to do it is in my investment account, i.e. that tax bucket that we talked about before, where they can always see it and they can always tax it. If I have an individual stock that I own and the price has gone from $100 a share to $50 a share, that loss of $50 a share, if I felt like this stock was not something I wanted to own anymore because I don't think the value, the fundamentals, the story I originally bought it for is there anymore, and I think it's going to be a loser for a while, I sell it. That loss from selling it, I can use to offset gain on the other stock that I have. So that's why people do tax loss harvesting. It creates a loss in a tax year that I can use to offset gains and reduce my tax bill. When are people doing it? I already said that. It's really about mitigating, reducing your tax burden. Now, what it requires is having stocks that are underperforming. So normally what I see is when I start working with someone, we can take advantage of a lot of tax loss harvesting in the first year or two. But at some point, we either are really in things we want to own long term, or we've gotten the sort of dogs out of the portfolio. So there may not be as much opportunity for tax loss harvesting. But that's where it fits in the analysis. It's just an additional strategy to reduce taxable income.
It's not really like a permanent strategy. It's more of a kind of deferring that tax for that year,
For that year.
the
Yeah.
gains that you have.
Yeah. And said a different way, it's like, I have to have a loss to take advantage of the strategy. It's a little bit like when people talk to me about oh man, I wish I could be in a lawsuit and win $1 million. I say, that's great, but now you don't have an arm. Do you really want to lose your arm to win $1 million? No. So, so that's the sort of the thing about tax loss harvesting. I have to have a loss to take advantage of it. I'd rather just not have the loss. But if I have it, I take advantage of it to reduce my income in that year. Yeah. Any other questions we should cover?
Could you, and maybe you kind of alluded to this already, but how do I project my like after-tax income when I get to
Mm,
retirement, and what
yes.
can I do to protect myself against the unexpected?
Oh, good one. That's a really good one. That's a really good one. Um, wow. Okay. Projecting my after-tax income. What I want to do is, again, use the strategy of funding the three buckets and then look at taking income from the three buckets in the right ratios so that I keep my tax bill as low as possible. How would I project that? You want to have a written financial plan, which, and there's a software that I use called eMoney that will allow you to fund your buckets to your financial freedom date. And then the software is able to actually, on today's tax rates, right? It's not future tax rates because nobody can know that, but on today's tax rates, it'll actually run a distribution scenario and show you what your net after-tax income will be annually through age 95. So it's very easy to calculate. And then what it also will do, Wayne, is it will not only show you that, but it'll show you that in three markets: really good markets, really average markets, really poor markets. And I recommend people do that because you not only want to run your analysis on a base case, but you want to stress the base case as well. So you really know you've positioned yourself for financial freedom. Um,
Do those also, I'm sorry, I didn't mean
okay,
to.
no, please.
No, does that also adjust for anticipate inflation or like the future cost of living or anything like
hmm
that?
It does. It does. And I'm so pleased you asked that because if I were to think about two things that shock people in their financial freedom, it is literally inflation and medical costs. Those are the two things that can really catch people by surprise. And so I like to drive this home. There's something called the rule of 24. Now we're really becoming, we're going to nerd out here, okay? Stay with me. There's the rule of 24. So I take 24, I divide it by my rate of return. That's the number of years that the calculation I'm doing it'll take to double. So if I do 24 and I use a rate of inflation of 3%, let's say, which is reasonable. Right now it's 2.5%. But if you look at it, a historical average over 100 years, 3% is a reasonably safe number to use. So 24 divided by 3 is what? Let's get our calculators out. So we don't, was that?
8.
Okay. I'm sorry. Hang on. Let me see. There. Take 72 divided by 3. 72 divided by 3, which is 24. I'm sorry. Because I know the So 24, so every 24 years it'll double. So if I need to live on $100,000 now, and I'm 20 years old, at age 44, that same lifestyle is 200,000.
Okay.
At age 44 plus another 24 puts me, is that 68? Did I do that right?
66.
66.
Or 64 plus 24? Yeah,
Yeah,
68. Sorry.
it's okay. It's all good. We're doing it. We're doing it now. 68, it'll be 400,000 for the same lifestyle.
Okay.
Do you see how powerful that is?
Yeah.
Now that works in our favor. That's compounding. I just showed you compounding by a different thing. That's why if I'm earning 6% and I'm delaying my gratification and I get my investing started more quickly, that number compounds. That same doubling takes place. It happens faster because 6% now, since I messed you up, I'm going to do it on my calculator. 72 divided by 6, that's every 12 years. So my 100 goes to 212 years, goes to 424 years, goes to 800, right? In another 12 years. That's the value of it. That's why investing early and often is the most important thing. One of the things I like to show people is if I want to save $1 million and I start in my 20s, I put away a few $100s a month. If I want to save $1 million by age 65 and I start in my 50s, it takes thousands of dollars a month to get to the same place. That's why this idea of using your retirement plan at the office, automatically increasing the percentage, is happening in the background, and that compounding will be very valuable. You also asked, Wayne, you talked about not only the income, but how do I deal with the unexpected? let me just comment on that real quick because that's the one that catches people. That's the other thing I see catching people when they talk about financial freedom. It's not the unexpected that is the issue. It's having the money to pay for the unexpected. Because if I can set my plan up to have the resources, then things that are in theory unexpected are not as bad. So let me break down what I mean by unexpected a little bit. First of all, you already said it, Wayne. If I need to send you a Starbucks gift card because the idea is if you are doing your own financial plan, Wayne, it's the first and only plan you're going to do. If you work with a financial advisor, he or she has done hundreds of them. So they are able to take what feels unexpected and make it and bring it into reality and say, look, because of the hundreds of families I've worked with, here are the things that are likely to happen. So now we don't have so much unexpected, right? That's the first thing. Second thing is where I see unexpected, it is a moral or emotional obligation. So you all as physicians probably know this, particularly physicians that are the one doctor in the family. You get people coming out of the woodwork. Hey, Wayne, can I borrow this? Would you send me that? So unexpected is people coming to you. So the value there is either being able to say no myself or putting somebody in between me and those people who will say no for me. That's the other way to deal with the unexpected. And then finally, the stress test I talked about before is the final way to deal with the unexpected. Because if I stress test my numbers, and even in a very poor market, I still will meet my financial freedom goals. I've essentially built in cushion to deal with some unexpected things because it is not likely that if we have a poor market, we'll have it for 25 years of my distribution. So it's another way of building in resources and cushion for the unexpected.
I don't
We
know
do
where.
have another question
Oh,
in the Q&A.
yes.
So this attendee asks, you talked about the 3 life phases. Can
Mm-hmm.
you speak to tips for the transfer phase?
Ooh, that's an estate planning workshop. So here's what I'm going to do. I'm going to give a book. And I think if you start there, it's actually very simple. Let me see. I'm going to look it up so I get the title right because I don't want to mess up the title. Give me 2 seconds. It's Beyond the Grave, the right way and the wrong way to leave money to the next generation. Okay, let me see. I wonder if I can take a screenshot. I'll see if I can talk and take a screenshot and put it in. Can one of you look it up and put the screenshot in there for me? Beyond the Grave. But the tips there would be, okay, a couple of tips I would give, but that book will be very helpful, is when you think about the transfer stage, you want to think about um, who is going to be the custodian of the resources. Because what you don't want to do is transfer from Wayne or Lauren don't want to send their money directly from them to their kids. Because what has happened is if the money goes directly to the kids, in less than a year, it's gone. So you want to make sure that you have a custodian, typically a trust, that will manage the money and pay it out to the kids over time, ideally tied to good behavior modification and good behavior reinforcement, like matching the gift on a house or matching the down payment on a house, matching the investment in a business, supplementing retirement. So don't go directly to the kids, go to a trust that will manage the money for a longer period of time. The other thing I would say is think about who will be responsible and have a backup. I see a lot of people put their documents together and they name a person that's like 10 or 15 years older than them. You want to make sure the person is your age or younger and then have a backup for them so that you make sure your plan is going to be in place for a long time. Those are some of the quick tips I would give you in terms of the trust. The other thing about the trust, about your transfer to the next generation, the number you want to keep in mind is today about, here, let me see it. Let me give you the exact number. It is $13,990,000. So let me round it up to 14,000. If you are going to have a net worth that is below that number as a single person or 2x that number as a married person, you will have less death tax to deal with because you're below the threshold. If you start getting above that number, you really want to do some extraordinary things to protect it because you're going to pay 40% tax on everything above that number. Yeah, exactly. Wayne's
Not a
eyebrows
very
went.
big number, so.
Yeah, exactly. So, but read the book. My email is in the chat, so anybody can feel free to reach out to me. I think we're at the end of time. So thanks everyone for joining in today. Wayne and Lauren, you did an awesome job. Thank you so much.
Oh, thank you. I learned a
Great.
lot and really appreciate your time.
I'm glad. Thanks so much. Everybody have an amazing day.
You too.
Bye-bye.
Bye.